Right, Sivaramakrishnan Ganapathi, Managing Director with Gokaldas Exports, joins us now. Mr. Ganapathi, good morning. Thank you for joining us. Let's first start with the moot point. Beginning of the year, everyone thought that there would be a recession in US and that will have impact on exporters. But of late, the guidance which we're getting from Walmart and other US retailers seems to be quite encouraging. How has the Christmas booking this time been for Indian garment exporters?
So Christmas is over. Nowadays, we are working for the summer season, summer of 2024. So for spring and summer of 24, we've been getting a fairly decent traction from the customers. So far, so good. The last year was characterized by excess inventory, which the US and the European retailers had. Most of the retailers have worked their inventory off. They're anywhere between normal levels to say 20% excess inventory, and that's all from crazy levels that they had earlier. Many of them have come back to reasonable level of normalcy. Hopefully, 2024 in the US, if the demand situation persists, that is retail demand, which was the case in 23, then I think the traction for Indian garment exporters will be fairly good.
When you say summer, you're talking about how the trends they're shaping up now?
So at the moment, we will be very soon entering summer production. By mid to end December, we will start summer 2024. Summer is like June, July, August of next year. So production happens in advance because these goods have to go to their warehouses and finally to their store shelves. So there's a lot of lead time associated with this. So in entire Q4, we will be producing for summer of 24. At the moment, we're trailing off the spring 24 production. And as I said, the traction or the demand traction for that seems to be fairly good. That's the reason why we are seeing YOY some amount of growth in the H2 of our financial year. I'm hoping that that trend will continue going forward. It will all depend on 2024 actual sales. The early signs of post-Thanksgiving sales seems to be encouraging. We will see how the sales runs up to Christmas. If that remains good, then the sentiment will be strong.
What about the outlook in terms of another key trigger that is playing out for your industry as a whole, the UK FTA? Can you quantify it as an opportunity for the company? What portion of this pie is it that you're hopeful of capturing?
So the way I see it is, if and when UK FTA happens, and we are keenly awaiting that to happen. I see that as a $1 billion opportunity for Indian garment industry. The reason is that we will get a level playing field with Bangladesh, which goes duty free into UK. So Bangladesh today exports about 4.5 billion to UK, whereas we export 1 billion. So when our costs come at par, landed duty paid in the in the UK, then I think for de-risking reasons, brands will tend to buy a little more. So I'm seeing an opportunity coming from there. And vis-a-vis China, we will be clearly 12% cheaper because China goes with duty and we will go without duty once the FTA comes into effect. So overall, I'm seeing it as a $1 billion opportunity. Players like us will definitely benefit by getting a share out of that. It will take 2 to 3 years before it builds up to that level, but that's a fairly good opportunity in my opinion.
Fair enough. And also, let's talk about in any sort of inquiries that you've witnessed in terms of an uptick over there with this UK trade deal. Are there any new customers that you've managed to onboard in light of this?
Yes, we did onboard a new customer from UK 6 months ago. That was keeping in mind the FTA discussions in progress. We also work with another large UK-based retailer. So we have 2 big UK-based retailers as our customers. Historically, US was our focus. So in anticipation of FTA, we have pivoted ourselves to catering to UK. But really, the traction will pick up once the FTA is announced. So we've been waiting for quite some time for the UK FTA to materialize. And I think, it will start becoming commercially feasible and commercially attractive only once the FTA comes into effect.
Not just that FTA with UK, but the government of India's push for upgrading India's textile ecosystem what we've seen with your latest Altraco acquisition as well. A lot of stars seem to be aligning in the right direction for you.
Right.
What's the rate that you expect it to grow in now, say for the next fiscal?
So I'm hoping that next fiscal, that is FY25 over FY24. I think we should gun for a 15 to 20% kind of growth, and that's quite doable in my opinion. We should probably, if things go well, we could even do better than that.
New capacity comes on board and capacity utilization rises. I'm guessing your operating leverage will also start to play out. So what's the improvement in margins that you're penciling in?
So improvement in margin is a function of many things. Other things being equal, I'm penciling in over the next 2 to 3 years an improvement of 1.5% because of operating leverage kicking in. In the short term, based on demand supply mismatch, for this year, for instance, we saw US buying about 25% less than last year and Europe buying about 16% less. So in these kind of situations, automatically there will be pricing pressure. So that puts the pressure on the margin. But once all these things run off, I have a feeling that from a steady state we can move it up by about 1.5%.
To go back to that whole macro fear, 2023 beginning, it was that there could be a soft landing. Now everyone is talking about a recession. But what you are telling us is that when you speak to your clients and your buyers, largely retail chains, they are not feeling the heat. In fact, they are confident of demand for 2024.
No, so what I'm saying is that in 23, there was a retail demand, that is end user demand, which grew by about 3% in the US. Having said that, the brands bought almost 25% lower than the previous year. That is because they were on an inventory destocking phase. So this, this phase, once it gets over, they have to correct for it. So, it'll have to go back to the previous period buying because the last year they literally sold off the excess inventory rather than buy from us. So to that extent, when whatever they sell in the forthcoming year, which is 2024, they will have to come back to buy. So the growth, which was negative 23% or 25%, in US imports in the last year, will have to correct itself regardless of the end user sales. That's what I'm saying. Even if, let us say, the end user demand is flat, I would say, there will be still some growth pickup because the inventory corrections would have happened. So that's the assumption I'm going with. It will not be a humongous growth given the macroeconomic sentiments. The high interest rates does pose concern on how the end user demand will pan out in calendar 24. But nevertheless, the brands will have to pick up inventory to stock themselves up, for which we are catering ourselves. We are gearing ourselves up for.
Final question: you are growing, or India is growing because China is not growing, or there is growth for everybody?
So definitely China is not growing, and that growth will come to other regions, including Vietnam, Bangladesh, India, Indonesia, and all of these regions. So that's happening, and larger players will have a disproportionate advantage because we can make the investments to grow. There is a degree of supplier consolidation which is happening in the industry, and the beneficiary of supplier consolidations will always be the larger players. So that benefit will certainly accrue to us.
Have you on board. Thank you for giving us that clarity. So